Who hasn't heard of Warren Buffett? One of the world's richest people, Warren Buffett also is one of the most successful investors of all time. Buffett runs Berkshire Hathaway, which owns more than 60 companies, including Geico Insurance, battery maker Duracell, and restaurant chain Dairy Queen, which is why it's not shocking that the investment strategy of Warren Buffett has reached legendary proportions. Buffett promotes many essential concepts and a theory of investing that is commonly practiced around the world. So just what are the secrets to his success? Keep watching this video to find out more about Buffett's strategy and how he managed such a fortune from his investments. Hi there, welcome to Investor's Game. Today we're gonna talk about how does Warren Buffett invest in the stock market. Don't forget to smash the like button and share this video with family and friends, that helps us a lot. So let's get started. Buffett began his career as an investment salesperson in the early 1950s, but formed Buffett Associates in 1956. Less than 10 years later, in 1965, he was control of Berkshire Hathaway. Also, Buffett follows the Benjamin Graham School of Value Investing. Value investors look for securities with prices that are low, based on the intrinsic worth. There's no specific way to determine intrinsic worth, but it's most often estimated by analyzing a company's fundamentals. Buffett takes this value investing approach to another level. Many investors' value do not support the efficient market hypothesis. This theory suggests that a stock always trades at fair value, which makes it harder for investors to either buy the stock at undervalued or sell them at inflated prices. They don't trust that the market will eventually start to favor those quality stocks that were for a time undervalued. He looks at each company as a whole, so he chooses stocks solely based on their overall potential as a company. Holding these stocks as a long-term play, Buffett doesn't seek capital gain. When Buffett invests in a company, he isn't concerned with whether the market will eventually recognize its worth. He is concerned with how well the company can make money as a business. Warren Buffett finds low prices value by asking himself some questions when he evaluates the relationship between a stock level of excellence and its price. Keep in mind, these are not the only things he analyzes, but just a short overview what he's looking for in his investment approach. Number 1. Company performance. Sometimes return on equity (ROE) is referred to as stockholders' return on investment. It reveals the rate at which shareholders earn income on their shares. Buffett always looks at ROE to see whether a company has consistently performed well compared to other companies in the same industry. And how we calculate ROE? Well, we calculate ROE dividing net income and shareholder equity. Looking at ROE in just the last year isn't enough. The investor should view the ROE from the past 5 to 10 years to analyze historical performance. Next, company debt. The debt to equity ratio, DE ratio, is another key characteristic that Buffett considered carefully. Buffett prefers to see a small amount of debt so the earnings growth is being generated from shareholders' equity as opposed to borrowed money. The DE ratio is calculated dividing the total liabilities between shareholders' equity. This ratio shows the proportion of equity and debt the company uses to finance its assets, and the higher ratio, the more debt rather than equity is financing the company. A high debt level will result in unpredictable profits and in sustained interest expenditures. For a more strict test, investors sometimes use a long-term debt instead of total liabilities in the calculation above. Next, profit margins. A company's profitability depends not only on having a good profit margins, but also on consistently increasing it. This margin is calculated by dividing net income by net sales. For a good indication of historical profit margins, investors should look back at least 5 years. A high profit margin indicates that the company is executing its business well, but increasing margins mean management has been extremely efficient and successful at controlling expenses. Next, is the company public? Buffett typically considers its only company that had been around for at least 10 years. As a result, most of the tech companies that have had their initial public offering IPOs in the past decade wouldn't get on Buffett's radar. He said he doesn't understand the mechanisms behind many of today's technology companies and only invests in business that he fully understands. Value investing requires identifying companies that have stood the test of time but are currently undervalued. Never underestimate the value of historical performance. This demonstrates the company's ability or inability to increase shareholders' value. Do keep in mind, however, that a stock's past performance doesn't guarantee future performance. The value investor's job is to determine how well the company can perform as it did in the past. Determining this is inherently tricky, but evidently Buffett is very good at it. One important point to remember about public companies is that the Securities and Exchange Commission requires that they file regular financial statements. These documents can help you to analyze important company data, including current and past performance, so you can make important investment decisions. Next, commodity reliance. You might initially think of this question as a radical approach to narrowing down a company. Buffett, however, sees this company as an important one. He tends to shy away, but not always, from a company whose products are distinguishable from those of competitors and those that rely solely in a commodity such as oil and gas. If the company doesn't offer anything different from another firm within the same industry, Buffett sees little that sets the company apart. Any characteristic that is hard to replicate is what Buffett calls a company economic moat or competitive advantage. The wider the moat, the tougher it is for a competitor to gain market share. Next, is it cheap? This is the kicker. Finding companies that met the other 5 criteria is one thing, but determining whether they are undervalued is the most difficult part of the value investing, and it's Buffett's most important skill. To check this, an investor must determine a company's intrinsic value by analyzing a number of business fundamentals including earnings, revenue, and assets. And a company's intrinsic value is usually higher and more complicated than its liquidity value, which is what a company would be worth if it were broken up and sold today. The liquidity value doesn't include intangibles such as the value of a brand name, which is not directly stated on the financial statements. Once Buffett determines the intrinsic value of a company as a whole, he compares it to its current market capitalization, the current total worth or price. Sounds easy, doesn't it? Well, Buffett's success, however, depends on his unmatched skill in accurately determining this intrinsic value. While we can outline some of his criteria, we have no way knowing exactly how he gained such a precise mastery of calculating value, as you probably noticed. Now, let's see the best holdings of Berkshire Hathaway. Comprising 49.1% of Berkshire Hathaway portfolio, Apple represents Buffett's largest holding. Berkshire Hathaway owns approximately 1 billion shares in the tech giant, worth $109 billion at the time of this reporting. This is the first tech stocks that Warren Buffett bought, and he said he bought Apple because it was undervalued for a long time, and he couldn't buy Apple before because he didn't notice how well Apple was doing. Next, Bank of America. With 1.03 billion shares to his name, Buffett's second largest holding is in Bank of America Corporation, valued at $24.1 billion and comprising 10.8% of his portfolio as of August 2020. Buffett's interest in the company began in 2011 when he helped solidify the firm's finances following the 2008 economic collapse. Next, the Coca-Cola Company. Buffett once claimed to consume at least 5 cans of Coca-Cola per day, which may explain why the Coca-Cola Company stock is his third largest holding. But one thing is for certain, Buffett appreciates the durability of the company core product, which has remained virtually unchanged over time, with the exception of the ill-fated new Coke formula rebranding in the mid-1980s. This makes sense, given that Buffett started buying Coca-Cola shares in the late 1980s, following the stock market crash of 1987. As of September 2020, with 400 million shares, valued approximately $19.2 million, Coca-Cola accounts for 8.6% of Berkshire Hathaway portfolio. Next, American Express is the second financial service company to make Buffett's top 5 list, occupying 6.5% of the portfolio. Berkshire Hathaway holds 151.6 million of shares, valued at $14.4 billion as of September 2020. Buffett acquired his initial stake in the credit card company in 1963 when it sorely needed capital to expand its operation. Buffett has since been a saver to the company many times over, including during the 2008 financial crisis. Next, Kraft Heinz. On February 2013, Berkshire Hathaway and 3J Capital announced a $28 billion deal to acquire global food brand Heinz Company. 2 years later, the company merged with Kraft to become the Kraft Heinz Company. In the years following the merger, the company has seen some rocky times, with shares prices dropping from a high of $19.6 per share in February 2017 to $20 per share in March 2020. Buffett's investing style is likely to shopping style of a bargain hunter. It reflects a practical down-to-earth attitude. Buffett maintains this attitude in other areas of his life. He doesn't live in a huge house, he doesn't collect cars, and he doesn't take a limousine to work. The value investing style is not without its critic, but whether you support Buffett or not, the proof is the pudding. If you like this video, don't forget to hit the like button. Let me know in the comment box, would you use Warren Buffett's strategy? Subscribe to my channel because every week I'm in YouTube with new content, and do not forget to activate the bell so you don't miss any of our videos. See you next time.